Hello and welcome to Exchanges for another week. The RBA has just raised rates for the third time in a row. There is signals from them that they may not be done. Inflation is clearly moving in the wrong direction and the household is the one being squeezed the most. And this time I didn't want to go down the angle of just looking at it purely from the economics. I want to look at it from the other direction, how the household is dealing with it, what the household is asking advisors around what they need to do to fund the debt that is now not just rising in price, but rising further than we've seen in for the last 15 years. Chris Foster-Ramsay is a very, very good expert to have in next. Mortgage broker, understanding the household, has clients of all persuasions that can really give us that insight that we need to now understand the RBA is putting on the whole country and where funding is going, how the household is dealing with funding, and how the household is just looking at debt in general. Do they look at refinancing? Do they look at a new mortgage? Do they then look at it in ways that we haven't seen in decades or years gone by? All those questions is the questions that I need to ask Chris. And so without any further ado, here is Chris Foster-Ramsay and this week's Exchanges. Chris Foster-Ramsay, welcome to Exchanges. We are recording this the day after the third rate rise in 2026 from the RBA. And instead of going down the full angle of jumping into all the economics and what this actually means, getting you on's a perfect time because of what you do and the kinds of people you talk to. You work in the refinancing and the mortgaging of people and how they deal with debt. So therefore, the first question straight away is, how does the third rate rise in 2026 play out in your world, and what are you already getting questions from them about how they're going to survive this?
Hi, Evan, and thanks for the opportunity to come speak with you today. I think that, if we look at that point, the biggest issue we're finding amongst our client base who, by way of background, is basically the average mum and dad borrower between about 25, 50. So they're the family market. Today, as I was saying, we've received a couple of distress calls, which we'll need to go down a specific route with. We've seen a number of lenders or loan applications in process that we need to give immediate attention to in terms of making sure that those customers are good to go and keep on their buying and purchasing journey, which you can come back to in a minute if you want. But in terms of those distress calls, I've already got 6 calls this morning from our customer base with, I need to meet with you as soon as possible to work out what to do.
So on that, because again, we were discussing also off air a week or so ago around what was already happening pre the third rate rise, which is more and more people are looking at the way that their mortgage works rather as a month-to-month payment setup rather than a full valuation, but also that they are somewhat skirting away from refinancing. They're not thinking about how to actually alleviate the pressure on the family budget. They're basically going, can I afford the monthly payments? Don't really care about the actual underlying capital. I just need to know this. And we're doing things that you said you hadn't really seen since, the lead up to the GFC, yes?
Yeah, that's right. So let's go back over that part of the conversation, which was for probably the last, 5, maybe pushing 10 years, we've had people come to us and I think the industry, in lending, anyone in retail lending has had a similar conversation, which is Evan will come into me and say, hey, how much can I borrow? How much will the bank lend me? And then I say, as the broker, X amount. Evan and his family says, we'll go off and shop to that limit. Not really concerned about what the repayment is because that's our borrowing capacity and we're very comfortable with the borrowing capacity. What I've seen over the last sort of, I reckon since, February, March, has been a complete flip in that position, which is they come and sit down with me, the same people, and they say, can you give me the borrowing capacity of what the bank will lend me based on where I sit now with what we've told you? On the flip side of that, though, I'm not really interested in how much I can borrow. I'm more interested in what the repayment looks like now with 1 rate rise, 2 rate rises and a full percentage point on that. And that's something I haven't seen for a very long time. And we're talking probably almost 20 years around that GFC point. Yeah. So it says to me that a lot more people are very concerned or very cognizant to the family budget and the amount of money or take home net money that they're putting towards housing.
So the next part of that discussion then is, are they looking at it as a percentage? Are they looking at it as, a repayment that they can handle per month? Because we know the data, and this is my world, is showing that the stretched households are now 35, maybe even as bad as half of their take-home pay is going to servicing their home, whether that's through mortgaging and some form of lending facility or through rent. What is that, how they're thinking on that? Is it around that idea that, I can afford a third of my pay packet to go out because it's net a pay packet, as you said, it's net a tax? Where's that psychology change happening?
So I think what we're seeing there is a conversation about what a family can afford and what comes out of their family budget. So it's net money in, money out, if that makes sense. It's not so much a percentage of earn. The question around the percentage of earn, though, is an interesting one. I agree. We've seen it move from 20, 25, 30, and it's now pushing more than that. And the only reason I think it's stopped going more than that is the new rules around debt to income ratios, which are being enforced. Different conversation for a different day, but I'm certainly seeing it sit in between that 30 to sort of 40% mark.
And then that's the worry that I've been watching too, is that without that sort of 6 times, 7 times, 8 times earnings number, that was sort of getting APRA a little bit concerned and watching macroprudential changes going in there that possibly kept going. So the flow-on effect is, what are they then looking for in their buying capacity? Because again, as you've just said, they're going, okay, this will be the monthly repayments. I can do that. What are they then finding in the market? Because what you're saying is they're okay to pay, let's just say, pick a number out of their head and do the average, which is about $2,500 to $3,000 a month, which will get you about a $660,000, $700,000 loan, give or take. What are they getting with that kind of rate and that sort of monthly payment in a market that's already stretched?
I mean, you tell me if this is sort of what you're thinking here. The way I am seeing that is that it becomes, if they're looking in an ex suburb that's close to family and friends and ticks all their boxes, and it's been their dream suburb that they've wanted to live in for a long time because of a whole lot of reasons, livability being the main one.
Yeah.
We're now seeing a ring around those suburbs that they're pushing out into. So it's still close enough to family and friends and livability scores, etc. But they're having to essentially settle for a second fiddle of suburb, and perhaps even in cases a smaller home. So they may have been, back when things were good, they may have been looking at a house. They may now be looking at a townhouse in a suburb, in a sister or bridesmaid suburb. Does that sort of answer the question?
The other thing that I'm also fascinated about with what we've just discussed, going back to the percentages of the household budget, we know inflation is the reason the RBA is getting really worried. We know that they've basically said the reason they've raised 3 times is that they've clearly made a mistake that they shouldn't have cut 3 times last year. That, I think, is the summary of what you can see them doing on Tuesday, the 5th of May. Are you starting to see that in the expenses? Are you starting to see that what they're now doing to come to someone like you is that they are making really hard decisions in their expenses so that they can afford what they think and they believe they want to have as their forever home?
Yes, absolutely. I'm seeing that, and seeing that more in the last sort of couple of weeks than, again, for a long time. The ones that where they live, breathe money every day of the week, they're inside their budget all the time. They're inside their banking app, working out what goes where and investments and whatever. The customer behaviour of that customer base seems to be that they're having to make sacrifices now for buying in a big picture type scenario. So either having to save harder, we see if overtime is available, more overtime is being taken, particularly in industries where overtime is looked favourably upon by lenders and banks. I cite emergency healthcare and emergency services just as one example of that. There are a whole lot of other ones though. So, AMBOs and police officers are doing just one extra shift or a double shift, or a nurse is doing double shift just to, with the bigger picture of buying a house.
Yeah. So
the other thing we're seeing,
because that would be the question, right? So this is the question that comes from exactly that point, right? That's the behavior. That's exactly what you would expect to see. People will do almost anything and everything to keep the shelter over their head, because that's what it is. A home is a shelter, and they will go above beyond. Can you go any deeper into the expenses? What are you seeing they're sacrificing?
Pretty much everything, anything that was discretionary. So holidays are coming back, travel is coming back, Grocery seems to come back a little bit as much as it can. Certainly going out and socialising, really expensive Uber Eats, that sort of stuff. That is all coming back. Subscriptions around Foxtel and online platforms, those sorts of things, they're all going. We actually had the other day, we went through this exercise with someone. It's probably an exercise for someone listening if they want to, but this particular customer wanted to come chop back on some of the subscriptions. They didn't know how to get rid of the ones inside the Google and the Apple platform. So if you grab your phone and you type into the search bar subscriptions, it brings up all the subscriptions that are really hard to get rid of that automatically paid for through a monthly Apple or Google subscription. So you can go in there and just take scissors to the whole lot. And that will, even if that's $30 a month, that's like $300 a year that can come back into other parts of your family budget.
Yeah. The other thing that I think is the next discussion with where the rates are going. There hasn't been a full change yet in the housing market. Okay, Sydney and Melbourne is starting to show last month or two that it's starting to go backwards. Are you worried about mortgage prison into the future? Is that the next concern that comes with where we are, particularly over the last 2 to 3 years where housing market has gone absolutely gangbusters again? The stretch was there. People were still buying on the way up. Even with the 3 rate rises down, they were still going. How concerned are you about mortgage prison? And explain what that concept actually is, if you wouldn't mind.
Yeah, sure. So mortgage prison is in its simplest form where you are bound to a home loan that has a repayment that was okay when you moved into the home and took the home loan out. But because of economic circumstances outside of anyone's control, rates move up. And because of either moving rates or the inability to negotiate a good deal with the lender concerned, you are paying higher than you otherwise need to. You can't refinance because the refinancing calculations don't work in your favour. And as such, you're stuck in what's called mortgage prison, which is you've just got to chip away and do everything you can to hold on to that roof above your head at the expense of a lot of other lifestyle and income and other challenges around that.
That also then raises refinancing, because that's going to clearly be the next question. With that 3 rate rises, stretch budgets, is refinancing going by the wayside, or is it the next thing that people will start coming to someone like you going forward of trying to find a better rate with a higher interest environment, possibly stagnating housing market and cost of living going through the roof again?
Yeah. So there's a lot to unpack there. So we just step through it sort of bit by bit. So in terms of refinancing, when someone comes to me and they say, like, I've had 6 calls today going, Chris, I need help with my rate. What's going on? What can you do? Can you ring the bank and negotiate for me? So if you're with a broker or a lender or a banker, you need to ring them and say, hey, this is my issue. Can you go to the lender and try and negotiate for me? Now, you got to remember that lenders are in the lending business, not in the real estate business, and they love retention. Particularly at the moment, there's one big bank that will do everything it possibly can to keep you there, drop the rate. If it's too high, in your view, drop it rate as much as possible to keep you. Now, that's the best of a whole lot of outcomes, but that's the best outcome is where your current bank goes, yeah, you're a good customer, we'll keep you, we'll just drop the points, we'll drop the interest rate and the repayment back in line with marketing so we don't lose you as a customer. If that doesn't work and I, as their broker, can't make that work, the next part of that conversation becomes, well, let's look at a lender that we can potentially move to with a competitive rate. And to do that, you need a whole lot of paperwork and you need to get the laundry list out that's been in the bin or in the cupboard for a long time. And you've got to get me or my peers some of those documentations. And for some people, that's just too much. They just can't do it. They don't want to do it. What we then need to do is work out whether there's an affordability angle there. And if we come up against an affordability angle or a negative equity angle in terms of what the valuation of the property is in a sliding property market, then we have a problem. So again, going back to that mortgage prison, that can land you in a sticky situation. Can I just hand back to you in terms of guiding this a little bit more for me, please?
Yeah. So the refinancing scenario also is one that is fascinating. So I'm going to pick you up on the bank that you've mentioned before. I'm not going to mention who it is. I know exactly who you're talking about. They have made a very big push. They're not just giving you a better rate. They might even throw cash at you in terms of making sure that you try and stay there. They're even offering you cash if you come over. So I think this is what's also forgotten by the household and by the consumer is that we talk about the RBA, we talk about what the rate is, we talk about rate rises, but they're actually entering the private lending market, not the public debt markets, which is where the banks play. they're entering a business world where they're up against competition. And so the refinancing question I have for you, as you just sort of alluded before, is you can get a better rate, is clearly what you're saying, even in a raising market. What you're also alluding to there, and this is probably where I want you to go a bit further, is that if you can do your homework well, you can actually get a better rate. And so how many people then come to you that have got, as you said, that laundry list of things they just cannot go through, that if they did, would actually find themselves in a better situation?
Yeah, there's a few. I wouldn't have any data right at hand at the minute around what percentage that looks like. But
so that point there is fascinating, Chris, because at the moment, everybody wants data. I'm like, well, data's great, except it's historical, right? It's not now. Anecdotal is that you can see this pressure coming. So I more want to hear your stories about what you're seeing from clients, about those that just sort of almost want to obfuscate to the idea, I just don't want to do that. Well, tell me why they should.
Well, there's two fascinating parts there. One is why they don't, and they don't want to because they have to pull all the data together. They have to, it's not just getting pay slips and giving mortgage broker a link to expenses. It's more than that. And that seems to be a mindset thing. It's what will Chris discover when he goes through my living expenses? I have another account that, I don't want to hand over to him. What scrutiny is he going to give if he can't sort of help to dial it down a bit? What scrutiny am I going to get from the bank? So it's a real opening themselves up to some scrutiny around money. And we find with these people, generally speaking, that there's more going on there than just not wanting to give me the information. It's an attitude and a bringing up of money. It's financial education. So again, separate story, separate day. But what I'm seeing is that in terms of numbers, might be 1 in 10, maybe 2 in 10, just going, well, if I refinance, why can't I just stay where I am? If I refinance, then I've got to move all my direct debits. I've gone down 5 years into a loan, I'm going to have to reset it to 30 years, which we've got ways around all of that to around financial education to help with that stuff. So it's part of a bigger picture that I don't want to because, and sometimes I don't want to because, and insert story.
Yeah. And that's also the fascinating part is that, just because you're getting a new 30-year loan doesn't mean you can't pay it off in 20 years. You are able to flex your payments is what you're also saying is here is, okay, the refinancing takes the pressure off now. And then in the future, you can bring your repayments up. So you're paying more, pay fortnightly over monthly is again, all those sort of tricks of the trade. I just want to pivot somewhere else because this is really catching attention for a lot of things that have happened, particularly leading up to this moment, as in the 3 rate rises we've seen in 2026. October last year, the government brought forward the 5% home loan guarantee scheme. How did have they come and sat in your office and gone, I had a 5% deposit. I've obviously got backed by the government, but the rate that I bought in October is now 75 basis points higher than where it was. I'm worried the housing market goes backwards. How do you address those first homeowners that got into that scheme that have certainly helped and accelerated, particularly the 4th and 5th tier of the Australian housing market? Where will they see themselves in October 2026, 12 months into a loan that, if we're honest, is pretty risky to start with?
Yeah. So I think the market, when they brought that announcement forward, and the market now is very different. Our good friends in government and treasury may not have thought that whole thing through. However, if we go back to the pandemic and what happened at the pandemic, where we had high LVR borrowers in that first home market, they were, based on data I can remember, that they were somewhat at risk. Maybe they'll help me with that, and somewhat at risk in terms of being the ones that were potentially going sideways. I think the first part of that is around financial education, and something we'll be doing in the next couple of weeks around anyone that bought under our help on that 5% scheme, which is making people aware of the importance of regular repayments over and above the minimum, making sure that we're doing our bit on our side in terms of advocacy, making sure that the lending rate is within market, that they're not overpaying, and then doing everything we can from doing revaluations, if possible, to try and get the LVR down based on any additional repayments they may have made, getting a whole lot of things that are in the tool belt that we can access. But I think to anyone that is in that scheme, that has bought with that scheme in mind or under that scheme, I think the first thing is just to be really open and honest with the person that's helped you get there. If you feel comfortable with them and you still deal with them, to what you're feeling, because what you're feeling is a lot of pressure. And a lot of people that own homes, me included, are feeling that pressure of what happens if it goes up again? What do we do? So head in the sand is not going to help here, but there are proactive things that we can do at the moment to try and drop the LVR, renegotiate with the bank on the lending product in place.
Just quickly on that. So just for those of you listening, with Chris and I talking about LVR, that's loan valuation ratio. The reason I go to that, my question for you just is, again, sort of a tidbit, how often should you be getting your house revalued? Because clearly, the more you get your house revalued, the ability to go to a lender and say, actually, my value is now X plus rather than the X that you have. Is there a recommendation that you have in terms of how often you should get your house revalued?
Or we do it on an annual review, or when a customer comes to us and says, hey, can you renegotiate the interest rate? Because part of the renegotiation of the interest rate is part of a loan to value ratio. So property value, updated property value versus loan balance. And even if you do that on a front hand, proactive basis, we do that. Not everyone does that, but the lender will do the same thing. So we go into a particular platform for, some of the fintech banks, and it automatically calculates their system against loan balance and what they believe the property is worth. So you don't actually need to ring up Chris and say, hey, can you revalue the house? A lot of it will happen in the background. And it doesn't have to be a real estate valuation either. We've got access, and many others have got access to RP data. In terms of answering the question in the most straight up and down way, you should be doing it every 6 to 12 months, just with a desktop valuation that you can get from any of the prop track or brokers or lenders, particularly if you've bought as an investment and you're moving into it as an owner occupied. Absolutely, you need a new bank valuation at that point for a whole lot of reasons. Again, I sit in the family budget space and the lending space. I don't fit in the CGT accounting economic space. But from what I understand, it really helps having the line in the sand valuation when it converts from investment back to owner occupied.
Yes, it does, in a big, big way. The follow on from that, in terms of where it is, how much of a difference does an loan valuation ratio of 80-20 compared to a loan valuation of 75, 70, 65 sort of movement actually impacts people's loan valuations? I don't think people fully understand how banks see that lowering of the risk actually impacts you.
It's massive. It is absolutely massive. And it's something I've seen a massive amount of competition come in the last 6 months. Some of the lenders that sit in that big sort of what I call 8 to 10 that don't have branches, that are more online, but really pushing for market share. A lot of those lenders will come out and give their best rates possible for both refinancing and to keep current customers at anyone that's got about 35 to 40% or more equity in their property. So loan to value ratios below 75 and below 60 is even massively competitive. They'll throw anything they can at you to do that. That, is almost, not that there's ever zero risk, but that is a very low risk.
Sort of slightly put you on the spot. Is it 100 basis points, 150 basis points better than a standard loan? Like, what kind of savings are you talking about here?
Yeah, so if we compare 60, and I can, don't have the data in front of me, but anecdotally, what I can see is that it's probably about 20 to 30 basis points, so 0.2 to 0.3 between an 80% loan, so you're borrowing 80% of the value of the property, compared to having a massive amount of equity at around the 60% mark.
And so, again, you're talking there, yesterday's rate rise can actually be completely taken out of the equation by having that refinancing question and having that loan valuation question. And this is why I wanted to have this chat today, which is these are the tricks of the trade to deal with the scenario that we're now going forward. So with that, this is the next part and the final part of the discussion we need to have. Going through your history of what you've been doing for the last 20, 25 years in your book, when you see scenarios like we're about to go through, and we are going through higher rates, higher expenses, what have been some of the do's and don'ts during, let's say, the GFC is a good example, and then going back to probably the early 2000s was another time we saw something similar. What are the do's and don'ts in your world going forward with the scenario and the environment we now are in?
Really interesting question. It's got so many parts to it. But if I can sort of keep to the budget part, I suppose, is probably the piece that comes to mind the most. I've had probably half a dozen customers say to us, look, we're really holding off making massive investments and things that are potentially going to put our budget at risk. So they're starting to hold back. And I think you're seeing that in other data around consumer confidence. So that sort of makes sense to me. The other part, I guess, if I look at those with a home loan at the moment, is around knowing what the numbers are and not being afraid to ask someone like me to renegotiate an interest rate, ask me questions or my peers questions about how they can get ahead. Now, if we look at weekly and fortnightly repayments, the difference there can be massive. I mean, look at, the data again seems to say to me in most cases that there's 5 to 7 years savings on a 30-year loan just by paying weekly or fortnightly, and potentially, squeezing that even more if you have an offset account in the mix as well. Now, there are arguments for and against offset accounts, and I get both sides of it. Around the family budget, I think, is a final piece there, really knowing what you need as a household to spend and buying things on special. We've started to see people buying ones or twos, extras of things and putting it in the cupboard just for they don't have to buy, for example, pasta that's on special now. The price now may vary to the price of pasta on special in 6 to 12 months because what we're seeing with fuel and oil and fertilizer, etc., in the next harvest of wheat, right? So we might see some changes there. It's that kind of smart shopping that we're seeing at the moment. Now, that's not buying every tube of toothpaste off the shelf and panic buying. We know that doesn't work. But it's smart shopping and doing budgets smart and roundabout way.
It's been a fascinating half an hour, and I can't believe we've sort of coming to an end. So I do have to finish with the question I finished for all of my guests, which is, Chris Foster-Ramsay, if you were in charge for just one day, what would you do? And you can choose anything with regards to what you're in charge of, mate.
I think if I look at that, it makes an interesting point. And I think that if I was in charge for a day, the first thing I'd do is probably look towards making things. It'd be great to go back to, that 90s era of when the world just worked. The kid, me as a teenager, was disconnected from technology. Family mealtime was valued. Kids would come and, I would cook dinner and my brother would cook dinner for us as a family and would really value their family time. Now, sure, we sat in front of neighbours and home and away and, got out of doing homework. But I think that, there's so much disconnection around that tech piece. And I think it's sort of eating away at the family unit. And I think, having 5 bowls of everything on the table, a pasta, a salad, some chips out of the oven, what it might be, and everyone's sort of helping themselves around conversation and having a good conversation while the TV's going in the background and then going off and doing your own thing for half an hour free of technology. I'd love it to come back to that. And I don't know whether that's sort of within the line of what you're looking for, but
it definitely is.
It'd be great to go back then. Yeah,
I know what you mean, right? So it's family, right? That is, having that family time. I grew up in a similar era, and that I do remember the same thing, right? It was, we all did, even if it was just watching TV, you did it together. It wasn't apart. Mm-hmm. That's a great way to finish, considering that we've been talking about the family and how the family is going to deal with this period. Chris Foster-Ramsay, it's been an absolute pleasure to have you on Exchanges.
Thanks so much for the opportunity. I'd love to come back. Thanks, Evan.
Big thank you to Chris for coming on. Great insights. Really different way of looking at what's going on right now, because clearly at the granular household level, that's the thinking. It's not about what I sit here and talk about with regards to the macro stuff and how the RBA views the world. It's the micro stuff that is clearly moving your world and your dial. I really do hope you understand and took some tidbits out of it as well about how to deal with and how to cope, and some tasks that you can both undertake right now to make sure that you get through this current period as well as possibly can be. As always, though, big thank you for listening, watching, and everything in between. We love having you listening to this program. 32% of you have subscribed. The rest of you haven't. If you can, please hit that subscribe button. We love developing this program. It's really, really taking off. And the more subscribers we can get, the better the program will be. Don't forget, we also have an email. If you've got any questions, ideas, or thoughts about guests, exchanges@evanlucas.com.au. But until next week, thank you so much for joining Exchanges. We'll talk to you then.